Hey everybody, welcome back to WhiteBoard Finance. Today we'll be talking about 2 proven ways to pay off your debt fast. One of these methods is more psychologically effective and the other is more mathematically effective. If you stick with either one of these methods, they will both get you to where you want to go. It just depends on what works best for you. Let's get into it. Okay, so what are these 2 popular methods? So if some of you are familiar with these, some of you are not. They're called the Debt Snowball and the Debt Avalanche methods. They're very popular to paying off your debt, but there is a major difference between the 2, which I'm gonna break down. Then I'll give you a quick example on the whiteboard, and then we'll take it to a calculator to show you exactly which one is more effective. So the Debt Avalanche method is math focused, okay? The reason for that is because it focuses on paying off your debt started with the highest interest rate first. The reason that this is math-based is because you're focusing completely on the debt with the highest APR, annual percentage rate, which has cost you the most amount of money in interest every month. This may take more time because you aren't looking at the total outstanding debt of the loan, just the percentage rate. So the Debt Snowball method right here is a little bit more psychological, which focuses on paying off your debt starting with the smallest outstanding loan amount first. So the reason that this is psychological is because it's designed to get you quick wins, and these quick wins, by scratching off all these debts off your checklist, it keeps you motivated and it continues to pay off your other outstanding debts. It's kind of like starting a workout plan, starting very simple, then graduating into either more weight, more reps, longer durations, things like that. So let's take a look at a quick example of the 2, and then we'll get into the scenario that's more of a real world example on the laptop here. Okay, so here's a very quick example so you understand how the Debt Snowball and the Debt Avalanche methods work. So let's say we have 3 credit cards, A, B, and C. These don't necessarily have to be credit cards, but I'm just making it super simple because a lot of people out there do have credit card debt. So first of all, why do you have 3 credit cards? So unless you're churning or using them for points, try to stick to a maximum of 2 credit cards. I personally have 1 personal, 1 business credit card. So if we were to use the Debt Avalanche method, you would start with credit card A, because it has the highest interest rate out of all 3 of these. If we were to use the Debt Snowball method, we would start with credit card C because it has the lowest outstanding balance. So this card has 1,000, this card has 2,000, this card has 750 outstanding, and then these are the percentage rates, 25, 15, and 22. So a common real world example of this is if you have, say for example, $25,000 of student loans at like 5 or 6%, and a mortgage that's, let's say, $300,000-$400,000 at 7%. You would probably start paying off the student loans first, even though the mortgage is 1 to 2% higher, because it would take you significantly longer to pay off that mortgage balance first. So let's dive into this really cool calculator that actually shows you the actual numbers of using these 2 debt payoff methods. But before that, let's get into a word from today's sponsor, Policy Genius. Life insurance is my family's financial safety net. My wife and I love to travel, but more importantly, we love our 2 little girls more than anything. If anything were to happen to my wife and me during our travels or everyday life, we know our girls will be taken care of financially. We got our life insurance plan using Policy Genius. Getting started with Policy Genius is simple. We filled out our information on their website, talked to their licensed agent, answered all of her questions, and she got back to us with quotes that made a lot of sense financially and covered our needs. Policy Genius knows how valuable your time is. Their technology makes it easy to compare life insurance quotes from America's top insurers in just a few clicks to find your lowest price. With Policy Genius, you can find life insurance policies that start at just $292 per year for $1 million of coverage. Some options are 100% online and let you avoid unnecessary medical exams. Their licensed award-winning agents can help you find the best fit for your needs. They work for you, not the insurance companies. That means they are not incentivized to recommend one insurer over another, so you can trust their guidance. Policy Genius is for parents, caregivers, and anyone else who has people who depend on them. They simplify the process of getting life insurance so you can protect the people you love. Although some of you have life insurance through your employer, you may not be as well covered as you think. Your family deserves peace of mind. A life insurance policy through Policy Genius can give it to them. Head to policygenius.com/whiteboardfinance or click the link in the description to get your free life insurance quotes and see how much you could save. Okay, so now let's check out a real calculator brought to you by Magnify Money. I think this is pretty interesting because it'll show you the actual math that goes behind this decision making. So as you can see here, I'll zoom in a little bit. You can enter as many credit cards as you want. And again, these don't have to be credit cards. Obviously, people have other loans, as I mentioned in the last slide. Student loans, mortgages, car loans, things like that. The reason I'm just using credit cards is because most people have credit card debt. So here's the way that I would use this. Again, this is from Magnify Money. I'm just using an example that they gave below. So we have credit card A with $5,626. We have an annual percentage rate of 29% and a minimum monthly payment of $200. Typically, credit card minimum monthly payments are anywhere from like 1 to 4%, right around there. Usually it's 1 to 3, more towards the high end. But again, this is just a hypothetical scenario. You can make up whatever you want, or you can use your actual numbers here. So the second credit card has a balance of $2,399. It has a 15% APR and a $75 minimum monthly payment. So now, depending on which style you want to use or which method you want to use, if you're using the Avalanche, you would obviously pay off credit card A first because it has a 29% APR, which is almost double the APR of credit card B. If you were to use the Snowball method, which is the more psychological method of, hey, let's knock out this small debt first, let's get it off the list, then we can attack our bigger debts, you would pay off credit card B first. But there actually is a mathematical correct answer, which we're going to look into right now. So if I scroll down, you can see here that if you have just $275 to put towards these things every month, you are making the minimum payments. However, by using the Avalanche method, you will save $508 and get out of debt 2 months faster. So this is what happens. If you pay back using the Snowball method, which is the smaller amount first, the outstanding loan first, you're going to pay back $12,709 over the course of roughly 4 years, 47 months. If you pay back using the Avalanche method, you're going to pay back $12,201 and you'll be out of debt in 45 months. So again, $508 cheaper and 2 months faster. So, however, the reason I'm making this video is because everyone is different, okay? Some people want small wins and it helps them keep going. Again, using that diet analogy or the exercise plan analogy, some people can't just jump into doing 50 pull-ups daily, 200 push-ups daily, 300 squats daily. They need to work their way up to that. So if you're checking small boxes and it helps you continue your debt payoff journey, then go with the Snowball method. If you're someone who understands the math, which I just showed you right here, and you don't care, you're going to just use the Avalanche method and pay off the highest percentage rate first. However, but the example I gave on the whiteboard, I intentionally made certain debt higher than the other, APR, because you're not going to avalanche or snowball into like a mortgage or a student loan or whatever the numbers may be. They're all different for your specific scenario. So hopefully this provided some mathematical context and also some psychological context. Either way, whichever one of these methods you decide to go with, stick with one till you get to zero consumer debt. Mortgages, especially if they're really low rates, say you have a 2.5%, 3%, maybe 3.5% mortgage, that's most likely an asset in this interest rate environment, given that 30-year fixed rate mortgages now in the United States are 7, 8, 9%, depending on your credit score. And then also, if you have, say, for example, a 1% car loan or a 0% car loan or a 0.99% car loan, does it really make sense to pay that off if you can earn 5% in a savings account or 5.3% with a T-bill, right? You're just making an arbitrage play at that point. If you're completely debt averse, that's perfectly fine. However, the math doesn't lie, and especially in those cases where you can arbitrage 3, 4, 5, 6%. So hopefully this was valuable to you. If it was, share it with a friend, share it on LinkedIn, share it on social media. And as always, thank you so much for watching and have a prosperous day. Do me a favor. In an inflationary environment, do not pay off low interest rate debt that is fixed, okay? Trust me. See ya.